In a quiet office lined with ledgers, a small group of men decides how much money exists in an entire nation. They don't wear crowns. They command no armies. Yet with a change in interest rates or the stroke of a pen, they can cool a booming economy, rescue a collapsing one, or if they miscalculate, ignite disaster. This is the story of how central banking rose from chaos, crisis, and desperate improvisation to become one of the most powerful forces shaping the modern world. Long before central banks, money was loud. It clinked in leather pouches. It was clipped, shaved, debased, and counterfeited. Kings routinely adjusted the value of coins to pay for their wars, shrinking the silver content while keeping the same royal stamp. It was a clever trick until merchants noticed. And trust, once broken, spreads panic quickly. Welcome to Behind the Money. We're here to decode the financial world, revealing the stories, the systems, and the power plays that define our modern era. If you've ever wondered about the real story behind wealth and influence, you're in the right place. Subscribe now, and let's uncover these secrets together. You'll never look at money the same way again. In medieval Europe, banking was private and fragmented. Goldsmiths stored precious metals in vaults and issued paper receipts for the deposits. Soon, those receipts began to circulate as money themselves. It was just easier than carrying around heavy sacks of gold. Slowly, a realization dawned. Not everyone would demand their gold back at the same time. This meant more receipts could be issued than the gold held in storage. Fractional reserve banking was born, not from some grand theory, but from everyday practice. But without any oversight, this system was incredibly fragile. Banks failed. Depositors rioted. Economies stalled. The first true experiment in central banking emerged from crisis in 17th century Sweden. In 1668, after a private bank collapsed under the weight of its own overissued notes, the Swedish parliament created the Riksbank. It was a radical idea, a bank tied to the state, designed to stabilize the currency and prevent financial chaos. Yet the real turning point came in England. In 1694, the English crown was broke. A long and expensive war with France had drained the treasury. The government needed money, and it needed it fast. A group of wealthy financiers proposed a deal. They would lend the crown £1.2 million. In return, they would be incorporated as the Bank of England, with the exclusive authority to issue banknotes on behalf of the government. It was a marriage of state power and private capital. Now, the Bank of England didn't look like the modern central banks we know today. It was still privately owned. It sought profit for its shareholders, but it had something new and exclusive: relationship with the government and a growing authority over the nation's money supply. Over time, its role evolved. It managed government debt. It learned how to stabilize financial markets during panics. And crucially, it became the lender of last resort, the single institution other banks turned to when fear spread faster than reason. The concept was revolutionary. When panic struck, the central bank would lend freely at a price to solvent institutions. The goal wasn't to reward recklessness, but to prevent the entire system from collapsing. Still, the path was anything but smooth. Throughout the 18th and 19th centuries, banking crises erupted regularly. In 1720, the South Sea bubble inflated and burst, destroying fortunes overnight. In 1825, a financial panic nearly brought Britain's banking system to its knees. Each crisis reinforced the same hard lesson. Financial systems require a stabilizing anchor. Across the Atlantic, the United States was learning this lesson the hard way. After independence, America experimented with central banking twice. The first Bank of the United States was chartered in 1791. It aimed to stabilize the young nation's chaotic currency. But suspicion of centralized power ran deep. Many feared it. Was a national bank a safeguard for the economy, or was it a threat to liberty? When its charter expired after 20 years, it was not renewed. The second bank followed in 1816, and it met a similar fate. President Andrew Jackson famously declared war on it, portraying it as an instrument of elite control. In 1836, he dismantled it entirely. What followed was known as the free banking era, but it was anything but free. Thousands of different state banks issued their own notes. The reliability of currency varied wildly from town to town. Bank failures were common. Economic booms turned into devastating busts with alarming speed. The Panic of 1907 became the breaking point. When a wave of bank runs hit New York, the United States had no central authority to intervene. Instead, one man stepped in, J.P. Morgan. From his private library, the aging financier summoned the nation's top bankers and industrialists, locking them in a room until they agreed to inject their own money to stabilize the system. The economy was saved, but just barely. The lesson was humiliating. A modern industrial power had relied on a single private citizen to prevent a total collapse. 6 years later, in 1913, the Federal Reserve was born. Unlike the highly centralized Bank of England, the Fed was structured as a hybrid system of regional banks overseen by a central board in Washington. It was designed to balance public oversight with regional representation. Its purpose was clear: provide an elastic currency, supervise banks, and finally serve as America's lender of last resort. Few could have imagined how quickly it would be tested. The Great Depression shattered confidence in global finance. Banks failed by the thousands. Unemployment soared. Central banks, including the Fed, were heavily criticized for tightening monetary policy at precisely the wrong time, deepening the crisis. The gold standard, once the anchor of global finance, became a constraint that nations struggled to escape. By the end of World War II, the world knew it needed a new financial architecture. In 1944, representatives from 44 nations gathered in Bretton Woods, New Hampshire. The result was a system that tied all major global currencies to the US dollar, and the dollar in turn was tied to gold. Institutions like the International Monetary Fund were created to promote stability. Central banking had officially gone global. For decades, this system brought relative calm and prosperity. But in 1971, President Richard Nixon unilaterally severed the dollar's link to gold. The Bretton Woods system collapsed. Currencies began to float freely, their values determined by market forces. Central banks entered a new era, no longer constrained by gold, but now fully responsible for managing purely fiat money backed only by government decree. And with that freedom came immense responsibility. In the 1970s, inflation spiraled out of control across the world. Prices rose rapidly. Confidence in money itself wavered. In the United States, Federal Reserve Chairman Paul Volcker took drastic action, raising interest rates to punishingly high levels. The move triggered a painful recession, but it ultimately broke inflation's grip. It was a defining moment. Central banks had proven they were willing to endure short-term pain to secure long-term stability. Then came 2008. The global financial crisis exposed vulnerabilities buried deep within modern finance. The market for complex mortgage-backed securities collapsed. Lehman Brothers fell. Credit markets around the world froze solid. Once again, panic threatened to spiral into a global catastrophe. This time, central banks responded with unprecedented force. Interest rates were slashed to near zero. Massive bond buying programs known as quantitative easing flooded the markets with liquidity. Trillions of dollars were injected into the global system to keep it from seizing up. Critics argued that these actions rewarded the very risk-taking that caused the crisis. Supporters claimed they prevented another Great Depression. Either way, one fact was undeniable. Central banks had become the ultimate economic firefighters. Today, they operate in a world of digital transactions, algorithmic trading, and cryptocurrencies that are challenging the very definition of traditional money. Some nations are even exploring central bank digital currencies, state-backed money that exists only in code. The evolution continues. From goldsmith vaults to marble institutions, from handwritten ledgers to supercomputers, central banking emerged not from a grand design, but from repeated crises. It was forged in war, refined in panic, and expanded through sheer necessity. And yet, the core question remains the same as it was centuries ago. Who should control the money? Because control over money is control over credit. Control over credit shapes investment. Investment shapes growth. And growth shapes the destiny of nations. The rise of central banking is not merely a financial story. It is a story of trust earned, broken, and painstakingly rebuilt. A story of power concentrated quietly in conference rooms rather than on battlefields. No crowns, no coronations, just interest rates, balance sheets, and decisions that ripple across the entire world. And in that quiet power lies one of the most consequential revolutions in modern history. Thank you for watching. If you found this story fascinating, be sure to like and subscribe for more deep dives into the forces that shape our world.